Hello and welcome to this week's market update.
Latest news.
As always, let's begin with the latest news. The US-China trade war has escalated quite significantly, with both China and the US having raised additional tariffs on each other's products. In fact, President Trump has raised tariffs to at least 145% on Chinese imports, and China has hence retaliated and increased retaliatory tariffs on US imports to 125%. On the other hand, the US has suspended tariffs on smartphones and computers, which is mainly likely due to the pressure he came under from US tech firms which import large amounts from China. On a more bullish front, President Trump did pause reciprocal tariffs for other countries, excluding China of course, for up to 90 days. However, there is now a universal 10% tariff on countries.
Weather.
Looking at the temperature forecast, we can expect some warmer than average temperatures for every day from the 1 to 10 day forecast, especially for Eastern European countries. Looking at the precipitation forecast, we can expect quite some rain, especially in Italy. And looking at the wind speed forecast, we do see some wind in the eastern part of Europe and in the Iberian countries, although overall wind has been quite muted throughout 2025, at least compared to previous years.
Crude oil and LPG.
Looking at the crude oil price evolution, we can see WTI and Brent crude oil prices for 2026 decreasing by around 1%, and the trend is clearly bearish, with prices decreasing by 13% for the last 12 weeks. The main reasons for this are, of course, number one, the US and Iran held talks on the Iranian nuclear program, which eased tensions in the region. OPEC Plus has also mentioned they would increase oil supply starting in May, which of course would hence increase global supply and therefore lower prices overall. Furthermore, ongoing trade war between the US and China has slashed economic forecasts and therefore has reduced oil demand forecasts, which of course is a bearish price driver. On the more bullish front, Trump has accused Putin of not playing along in the ceasefire negotiations between Ukraine and Russia, and has made claims that he could increase Russian sanctions on Russian oil.
Natural gas.
Looking at the TTF price evolution, we saw decreases last week in the calendar 26 product of 3.2%, which is in line with the previous 12-week price evolution trend of minus 19%, clearly showing a bearish trend overall. Part of the reason of this bearish trend can be seen from the storage inventories, although as you can clearly tell, we are quite below last year's levels, which means we will need a strong refilling season throughout the summer. And a proposal which has now been agreed to of lowering or of increasing flexibility for the target of 90%, the mandated target of 90% in November 1st, has now been amended, where countries can now reach the 90% level anywhere between October 1st and December 1st, hence easing summer demand. Looking at net storage withdrawals, we now inject more than we withdraw, as of course we exit the winter seasons and gas demand eases quite significantly due to lower heating demand. We can clearly see quite an important spike during the end of April, beginning of May, or downturn as I would say. This was mainly due to a cold spell that we saw during that period, which increased gas demand quite significantly. This is something that we can see on the graph to your right as well, where you can clearly see a strong hump there at the end of April, beginning of May, which will be interesting to see whether we see the same effect this year or not. Looking at the European gas supply mix, LNG has now officially become, at least looking at the 100-day rolling average, the most important gas supply source for Europe. Of course, most of it comes from the US, and therefore US imports, LNG imports, have become more crucial than ever. Looking at the total share of LNG imports, quite interestingly, in Q1 25, Europe's share increased quite substantially, whereas the share to Asia decreased. This is mainly due to the price premium that we saw in Europe due to the increased demand and low renewable energy generation, which hence increased gas prices for Europe and therefore made it more attractive for LNG suppliers to sell to European countries.
Coal.
Now looking at the coal price evolution, looking at the last week, we did see API2 decreasing by 1.6%, whereas API4 increased by 2.3%, although the overall trend remains quite neutral. The main price drivers here are the low Rhine water levels that we're seeing in Europe, which could potentially disrupt supply in the near future. However, we're also seeing a lot of muted demand coming from China, and also quite strong supply in the ARA stocks when we consider European supply.
EU and UK emission allowances.
Now moving along to emission allowance price evolution, we have quite a different story when comparing European carbon allowances with UK carbon allowances. We can see a slight increase last week for European allowances, whereas we saw a strong increase for UK carbon allowance prices. And this is very similar to the past 12-week trend, where we see a decrease on one side and an increase on the other. The reason why we see decreases for the European carbon prices is due to the tariff announcements, which of course assume a slash in economic growth and therefore lower fossil fuel consumption and therefore lower emission allowance demand. On the other hand, there has been talks of potentially putting back the UK carbon allowance prices and putting them back with the European carbon allowance prices, and hence the spread between these two indexes has narrowed quite significantly over the past few months. Looking at the estimated European power sector emissions, as you can clearly tell, so far in 2025, we have been above last year, in particular in February, where we saw a lack of renewable energy generation and quite strong gas consumption due to heating necessities. And finally, looking at investment fund positions, we clearly see a downtrend when looking at European futures, but we do see an increase when looking at UKA futures, again, mainly due to the reason mentioned before of the potential recorrelation between both indexes.
Electricity.
And now looking at the German price evolution, the most liquid power market in Europe, we can clearly tell that looking at the year products, we saw very slight decreases on the weekly price evolution for calendar 26, although increases further along the curve. And interestingly, we did see some relatively stronger decreases when looking at Q3 and Q4 products for 2025. This is a very similar trend as to what we see for other European countries as well. Looking at renewable energy generation at the top of your screen there, we can clearly tell that we've been below last year's level for most months, and that has therefore caused fossil fuel generation to be above where we were in 2024. This is mainly due to the relatively weak wind generation that we have seen. However, we are now seeing much stronger solar, or quite a bit stronger solar generation so far compared to 2024. And this will, of course, become more and more important as we head into the summer months and as solar generation becomes more essential to the European supply mix. Looking at fossil gas generation, we can clearly see a decrease, and this is due to the lower heating demand that is required now as, of course, temperatures have increased. And finally, looking at the guarantees of origin price evolution, last week for most products we saw prices decrease, which is a trend that we've been seeing from September 24, although from February 2025 we did see prices stabilize and have now a bit more of a neutral price evolution overall. Thank you very much for listening, and from everyone at E&C, we wish you a great week ahead.